Gold just put up an average around $4,530 in the middle of a so-called global slowdown, then sprinted toward the high 4,800s anyway. And the uncomfortable truth is this: the headline price is not even the most bullish part of the setup. Something is actively trying to frame this as a sentimental safe haven trade that should fade the moment growth prints weak. And that framing is convenient because it distracts you from the mechanical pressure building underneath the market. And later in this video, I'm going to give you the 3 levels that matter, the 1 calendar window that can flip this from steady climb into air pocket or gap higher, and the simple checklist that tells you in real time whether this move is being powered by real structural demand or whether it's about to get mugged by liquidity, because that's where the real pressure starts. The public story says slowdown equals weaker demand, risk off, maybe a stronger dollar, maybe lower inflation, and therefore gold should cool off. That's the neat classroom version. But gold right now is behaving less like a frightened animal and more like a battering ram, like it is front-running a policy response, a currency stress response, and a reserve management response all at once. And when you see that kind of behavior, you stop asking, is this emotional? And you start asking, who is being forced to do what? Because price doesn't move in a vacuum. Price moves when participants are compelled to adjust. And if you're watching gold through that lens, the slowdown narrative doesn't weaken the bull case. It can actually reinforce it if it pushes the system toward easier money, heavier deficits, more hedging, and less trust in paper promises. But that's not the part that matters. The part that matters is that gold S move has been fast enough to trigger reflexive behavior in derivatives and slow enough to look orderly to casual observers, which is exactly how the biggest flows like to operate, quietly until they're not quiet anymore. Let's ground this with context quickly, because credibility matters, and finance audiences can smell hand-waving from a mile away. In early January, you could still find gold with closes around the low to mid $4,300. Then the market started stepping up into the mid 4,400s, then the mid 4,500s, and within weeks, it was flirting with that $4,900 handle. The month-to-date move has been big enough that even people who done a T-watch gold started noticing it, and that's always when the psychology games begin. And that's why I'm being blunt. If you only watch spot charts, you're late to the story. The hidden detail lives in the plumbing: spreads, rolls, delivery timing, and the way dealers hedge options exposure. And if one level breaks, the math changes. Here's the conflict in one sentence. The macro crowd wants to frame this as a simple response to slower growth, but the market structure is acting like there's a scarcity premium trying to leak into the paper price. That doesn't mean conspiracy. It means incentives. It means constraints. It means a whole lot of professionals staring at the same calendar and realizing they need to adjust risk at the same time. And synchronized adjustments are where markets get jumpy. So let's talk about the hidden detail without turning this into a lecture. Gold is not just a thing you buy. Gold is a network of promises: futures contracts, forwards, swaps, unallocated accounts, ETFs, vault inventories, refinery throughput, and physical bars that have to meet specific deliverable standards. The headline spot price is basically the front page number, but the real story is whether nearby exposure is becoming more expensive than it should be, whether the curve is behaving normally, and whether the market is paying up to have gold sooner rather than later. Because when that happens, it forces behavior. And forced behavior is what creates trending moves. Normally, durable, easily storable commodities like gold spend most of their time in contango, meaning futures prices a few months out are a bit higher than spot, reflecting storage, financing, and convenience. It's boring. It's what normal looks like. When gold stops being boring, when the curve flattens unusually or nearby contracts start acting tight or the roll gets choppy, you pay attention, not because it's mystical, because it means the cost of carrying exposure is shifting, and that shift has winners and losers, and some of those losers are levered, and levered players don't get to be patient. But here's the twist. Even if you don't personally trade futures, those mechanics can still move the price you see, because arbitrage stitches these markets together. If the nearby futures contract starts behaving like it's special, arbitrageurs and hedgers react. If physical premiums in one region rise versus another, arbitrage reacts. If ETFs start absorbing metal, vault flows react. And the paper price adjusts to reconcile those pressures. That's the signal most people miss. And that is why the price can look too high to a macro commentator and still have fuel. Because the fuel isn't a feeling. It's positioning plus constraints plus calendar. And the calendar is the catalyst. Let me make that real. Futures markets have deadlines. Options markets have deadlines. Funds have rebalancing schedules. Risk managers have VAR limits that tighten when volatility rises. When you approach one of these deadlines, the market doesn't care what you believe. The market cares what you must do. If you go long futures into a delivery window and you don't want to take delivery, you roll. If you were short futures into delivery and you do not want to risk assignment, or you do not want to post more margin into an adverse move, you cover or you roll. If you sold calls and the market climbs toward your strike, you hedge. If you're a dealer and your book goes from comfortably hedged to O in a few sessions, you adjust deltas, and those adjustments can create demand right when liquidity is thinning. And thin liquidity is how normal moves turn into violent candles. That's where the real pressure starts. Now zoom in on why now. It's not just gold is up. It is that gold is up into a period where liquidity can be patchy and where derivatives positioning tends to reset. Late month flows, option expiries, futures roll windows, and the constant rhythm of systematic funds that adjust based on price and volatility. You can think of the market like a crowded theater. If everyone stands up at once, it's chaos. If people stand up in waves, it's manageable. The calendar tells you when the waves are likely, and right now the waves overlap, which means the market is more sensitive than it looks. But that's not the part that matters. The next detail is what flips the whole setup. There is a common mistake investors make with gold. They treat it like a stock with a story. Gold doesn't care about your story. Gold cares about real rates, currency confidence, geopolitical hedging, and the flow of institutional allocations. And lately, those allocations have been anything but small. Central banks have been consistent buyers in recent years, and that matters because central bank demand isn't a T chasing a breakout candle with a stop loss under yesterday S low. Central bank demand is structural. It's portfolio construction under uncertainty. It's reserve diversification under sanctions risk. It is a response to a world where holding someone else's liability feels riskier than it used to. And when that kind of buyer is present, price can stay supported through pullbacks that would normally scare retail out. You can see the narrative shift in how big institutions talk about the metal. When major banks float targets like $5,400 toward end 2026, and some strategists even throw around more aggressive numbers, don't treat it like a horoscope. Treat it like a model output. They read telling you what happens if the flow assumptions remain intact. Central bank accumulation, ETF demand resurgence, rate cuts, and continued geopolitical uncertainty. Whether their targets hit or not is less important than the mechanism they're pointing at. Because if the mechanism is real, dips become contested. And that is exactly the behavioral signature of a structurally bid market. Pullbacks are sharp but short because someone is waiting. But here's the catch. In a structurally bid market, the market will also try to shake you out. It has to. It needs liquidity. It needs sellers. It needs people to panic so stronger hands can buy without paying even more. And that's why your psychology matters as much as your thesis. And the market doesn't need to prove you wrong to hurt you. It only needs to whip you around enough that you abandon your plan. So if you're watching this and thinking, okay, so gold is going to $5,000, slow down. A credible view isn't a single path. It's two scenarios. Scenario one is the controlled pullback. Gold cools off, retests a breakout zone, and then continues higher as that retest becomes support. Scenario two is the continuation squeeze. Gold keeps pushing, and because the options book and futures positioning are set up a certain way, the move accelerates into gaps and air pockets, especially around big psychological levels. Both can happen, both can be tradable, and both can punish you if you confuse noise with signal. Because if this one level breaks, the math changes. Let's talk mechanics in plain language. Options reflexivity is a fancy phrase for something simple. Dealer's hedge. If a lot of call options are outstanding at certain strikes, and price approaches those strikes, dealers who sold those calls often need to buy the underlying or buy futures to stay hedged. The rate at which they need to hedge changes with the price. In certain configurations, especially when gamma is high, price moving up forces hedgers to buy more, and that buying pushes price up more, which forces more buying. That's reflexivity. It's not a conspiracy. It's an equation. And you don't need perfect data to understand the risk. Big round strikes like $5,000 can become magnets. Sometimes price pins under them as hedgers dampen movement. Sometimes price rips through them because the hedging flips from damping to chasing. And when it flips, the tape feels like it's on ice. But that's not the part that matters. The part that matters is how this interacts with futures structure and delivery timing. Futures contracts have expiration months. If you hold the front month and you don't want delivery, you roll to a later month by selling the front and buying the next. When a lot of participants roll around the same time, the spread between those months becomes a battleground. In calm markets, the roll is smooth. In stressed markets, the roll gets expensive or choppy. That's a tell. Because it reveals whether there's a premium on immediacy. If the nearby contract is being bid relative to the deferred, that can signal tightness or urgent demand for exposure now. And even if gold as a physical commodity is abundant relative to most commodities, because so much of it exists above ground, the deliverable categories still matter. Gold is not one homogeneous pool. Deliverable bars have standards. Vaults have reporting categories. There are registered or deliverable inventories versus eligible inventories that meet specs but aren't earmarked for delivery. There are location constraints. There are financing constraints. There are bottlenecks between unallocated claims and allocated bars. When those bottlenecks tighten, the paper market can feel friction. And friction is what turns a slow grind into a squeeze. But that's not the part that matters. Here's how you turn this into an evidence-driven read without pretending you have magical insight. You stack proof points. You don't rely on one. First proof point, the curve and the roll behavior. Is the market paying a normal carry, or is nearby exposure acting unusually tight? Second proof point, inventories and deliverable categories. Are there signs that metal is being pulled into specific vault systems, or that delivery activity is rising? You don't need exact numbers. You need direction and context. Third proof point, institutional flow. Are ETFs seeing inflows again? Are funds increasing exposure? Are reported open interest levels rising while price rises? Fourth proof point, global comparisons. Do certain regions show persistent premiums that suggest stronger physical demand? Fifth proof point, chart structure. Did price break a prior resistance and hold, or is it spiking and failing? Sixth proof point, macro alignment. Are real yields falling? Is the dollar weakening? Are policy expectations shifting toward easing? The power is in the stack, because if 4 or 5 of those point the same way, you're not guessing. You're reading pressure, and pressure is what markets obey. Speaking of open interest, when you see open interest in gold, futures staying high or even rising while price is pushing, that can be a sign that this isn't just shorts capitulating and leaving the building. It can mean new risk is being layered on, new longs, new hedges, new structures. And if that risk is positioned the wrong way into a sharp move, margin becomes the accelerant. Here's the ugly but useful truth. Margin calls don't care about your thesis. If price rises and you're short or you're in a structure that bleeds, your broker doesn't ask for your macro view. They ask for cash. If you don't have it, they close you. That forced closure is buying pressure in a rising market. And forced buying in a market with thinning liquidity is how you get those "it moved $100 while I blinked" moments. But that's not the part that matters. The next detail is the slowdown itself. People hear slowdown and think demand destruction. In many commodities, that's right. In gold, slowdown can mean something else: policy response, currency debasement fears, and an increase in hedging demand. If growth is weakening while inflation remains sticky, or if deficits keep growing and the political appetite for austerity is low, then the path of least resistance is easier financial conditions at some point. Even the expectation of rate cuts can matter, because gold responds to real yields and to the opportunity cost of holding a non-yielding asset. And beyond rates, there's the credibility channel. Gold is a hedge against the idea that paper systems can be managed smoothly. When the world feels less smooth, geopolitics, sanctions, trade fragmentation, questions about reserve safety, gold gets a structural bid. That's not a moral statement, it's portfolio math. And the most important word there is structural. Structural demand changes the character of pullbacks. It doesn't eliminate them. It changes how they resolve. But here's the trap. The same structural bid that supports price also creates the perfect environment for volatility to be weaponized. You will see fast downdrafts. You will see days where price drops hard on what looks like nothing. You will see the media latch onto one explanation: profit taking, strong dollar, jobs data, risk on rally, whatever. Sometimes the explanation is true. Sometimes it's just narrative glue slapped onto a liquidity event. The point is not to become cynical. The point is to become operational. Your edge isn't predicting headlines. Your edge is knowing what matters this week. And what matters this week is the intersection of levels, liquidity, and calendar, because that's where the real pressure starts. Let's bring this back to your title. An average around $4,138 amid slowdown. That average matters because it suggests the market is comfortable holding a higher plateau, not just spiking and collapsing. Plateaus in commodities often form when new buyers absorb supply and when sellers stop being able to push price back into the old range. The market is telling you, we recalibrated. And when markets recalibrate, they often test that calibration. That's why the next 1 to 2 weeks are critical. You're likely to see either a controlled pullback that retests a breakout zone or a continuation push that tries to tag and maybe pierce the next big round number. And that's why you need a simple roadmap, not a vibe. Here's the roadmap, stated cleanly. On the downside, watch the mid-4,700s area as a first line of defense. Call it the zone where a lot of recent trading action has likely clustered. If gold pulls back into that zone and buyers defend it quickly, that's scenario 1, controlled pullback and retest. It tells you the bid is real. It tells you dips are being bought. It tells you the move is not just a thin air spike. Below that, you care about whether the market can hold the low to mid $4,600 region, because if it breaks cleanly and stays broken, the character changes, not forever, but for this month's setup. On the upside, the $4,900 to $5,000 zone is the psychological ceiling and the market structure zone. That's where options positioning can matter, where media attention intensifies, where retail FOMO tends to spike, and where the market loves to punish late chasers with a fast reversal, right before continuing higher later. And that's not a joke, that's a pattern. Because that's how liquidity is harvested, but that's not the part that matters. The part that matters is what confirms each scenario. Confirmation for scenario 1, the controlled pullback, is a quick reclaim after a dip, stabilization on higher lows, and a lack of panic in the curve and spreads. In English, price dips, but the market doesn't feel stressed. Confirmation for scenario 2, the continuation squeeze, is acceleration into that $4,900, $5,000 zone with rising urgency, thinner order books, and a sense that the tape is being pulled upward rather than walked upward. In English, you start seeing gaps. You start seeing days where price doesn't give you a clean dip. You start seeing the kind of relentless bid that makes shorts uncomfortable. In validation, what weakens the bullish thesis near term is not a red candle. It's a structural failure, a clean breakdown of key support that holds for more than a day or two, combined with signs that flows are reversing, like ETF outflows picking up, real yields rising hard, and the dollar catching a sustained bid. You're not looking for perfection. You're looking for alignment, but that's not the part that matters. The next detail is your psychology shield, because most viewers lose money not because they're wrong, but because they're early, undercapitalized, or emotionally reactive. If gold is in a flow-driven regime, volatility will be used against you. You will see sharp dips that feel like the top. You will see sharp rips that feel like you're missing the move forever. Both feelings are traps. The shield is simple. Separate your time horizon from the tape. If you're a macro investor, your signal is weekly structure and flow indicators, not 5-minute candles. If you're a trader, your signal is level-to-level behavior with tight risk controls, not I think it'll go up. And either way, your rule should be never make a decision at maximum emotion. If you feel panic, you pause. If you feel euphoria, you pause. You wait for structure, because structure is information. Emotion is noise. And if you can't do that, the market will do it for you by taking your money and teaching you the lesson the expensive way. Another shield, position sizing. This is where people get offended, but it's reality. If your position is so large that a $150 move makes you physically uncomfortable, your position is too large. Not because your thesis is wrong, because you can't execute under stress. The market doesn't reward conviction. It rewards survivability. And survivability is boring. It's sizing, it's time horizon, it's knowing your invalidation level before you click buy. But that's not the part that matters. The part that matters is how to watch the hidden detail in real time without pretending you're a professional spread trader. You watch proxies. You watch whether the rally is being accompanied by stable or rising participation, volume and open interest in futures, the tone of ETF flows, the behavior of the dollar and real yields, and whether pullbacks are bought quickly. You watch whether the market is paying up for immediacy through curve behavior and nearby strength. You watch global physical cues. Are there persistent premiums in key hubs that suggest physical demand is strong? You watch for the tell of a crowded move, when everyone suddenly has a gold take and the takes get emotional. That's usually when the market does a fast shakeout. And that shakeout doesn't mean the bull is dead. It means the bull is collecting tolls. So where does the global slowdown fit into this without turning into a doom sermon? It fits as the backdrop for policy and currency stress. If growth slows, governments don't magically reduce spending. They often increase support. If inflation is still a political problem, easing becomes messy. If the world is fragmenting, reserve managers care about what can be frozen and what cannot. Gold benefits from that uncertainty, not because it's magical, but because it's no one else's liability. And if you've been watching the trend in central bank accumulation and the renewed interest from private investors through ETFs when conditions align, you understand why big banks are comfortable publishing targets above $5,000. Again, not a guarantee, a scenario, a flow-based scenario, but that's not the part that matters. The next detail is the risk that nobody likes to say out loud. Even if the thesis is correct, price can whip around violently. Gold can drop hard on a day where rates spike, where the dollar rallies, where risk is deleveraging across assets, or where liquidity just vanishes. That drop doesn't invalidate the structural story unless it breaks structure and persists. This is the difference between trend signal and noise. Noise is a fast move that doesn't change the underlying incentives and flows. Signal is a shift in those flows, a sustained break of structure, a change in the curve behavior, a turn in real yields and the dollar that lasts. If you can hold that distinction, you stop getting emotionally hijacked. And once you stop getting hijacked, you start seeing the market clearly. That's where your edge is. Now let's make the what comes next brutally practical. Over the next week or two, you're watching three things. 1. Can gold hold above the mid 4,700 zone on any pullback? And does it reclaim quickly if it dips? 2. Does the market test the $4,900, $5,000 region? And if it does, is it a clean tag and reject, or does it grind and then snap through? 3. What does the calendar force people to do? Are we moving through a window where options, hedging, and futures rolls can amplify moves? If those three line up bullish, you respect the trend. If they break bearish, you don't cling to a narrative, you adapt. Because the market is not your identity. It's a machine. And you're here to read the machine, not worship it. But that's not the part that matters. The part that matters is how you behave when the machine tries to trick you. If we get scenario 1, the controlled pullback, the move will feel boring after the fireworks. That boredom is a trap too, because it tempts you to overtrade. If we get scenario 2, the continuation squeeze, you will feel urgency. And that urgency is the bigger trap, because it tempts you to chase at the exact moment the market is most likely to slap late buyers. The correct response to both is the same. You stick to levels and invalidation. You don't let the tape negotiate with your emotions. You decide your plan when you're calm and execute it when you're not. And if you want one last hidden detail to keep in your pocket, it's this. Big round numbers aren't just psychology. They're where derivatives, positioning clusters, where risk limits trigger, where rebalancing flows hit, and where the story becomes self-fulfilling. $5,000 isn't just a number, it's a spotlight. And spotlights change behavior. They change how fast money trades. They change how media frames moves. They change how retail participates. And they change how institutions manage exposure. So when we approach that zone, you should expect the market to act different, faster, meaner, more theatrical. And that theater is not a sign you're wrong. It's a sign the game has changed from walk to sprint. If you're the kind of investor who wants to build wealth without getting emotionally destroyed, you don't sprint with the crowd. You let the crowd sprint, and you operate with structure. That's what serious money does. That's what survives. And that angst what we are building here, a mechanics-first crowd that doesn't get hypnotized by headlines or shaken out by volatility. If you want to be part of that, stay close, because the next couple of weeks in gold are not about beliefs. They're about flows, deadlines, and levels. And if one level breaks, the math changes.